Good afternoon, and welcome to our 2026 Capital Markets Forecast: Trade, Labor, and Debt Under the Microscope, presented by Wilmington Trust, part of the M&T Bank family. Now I'll turn it over to our moderator, Lisa Roberts.
Thank you, Robin. Hello, everyone. I'm Lisa Roberts, Head of Wealth Management at Wilmington Trust. And first of all, Happy New Year. Thank you for joining us for this in-depth look at our 2026 Capital Markets Forecast. Investing has always been about balancing insight, experience, and analysis. And when you think about the policy changes, the demographic shifts, and rapid innovation reshaping the landscape, that balance, it's more critical than ever. And so our investment management team sees these dynamics as defining forces that could influence markets for years to come. So joining me today to share these perspectives are our Chief Investment Officer, Tony Roth, our Chief Economist, Luke Tilley, and our Chief Investment Strategist, Megan Shu. And we have a lot to cover today, so we're just going to dive right in. And Tony, please kick us off with a high-level overview of the CMF. The title itself, it's provocative: Economic Experimentation, Trade, Labor, and Debt Under the Microscope. So what do we mean by economic experimentation?
Well, Happy New Year, everybody, again, and thank you so much, Lisa, for hosting us today. So if we roll back 1 year and we think about what we talked about last year, which was chutes and ladders, we came into the year last year by comparison to this year, and we were quite optimistic. We had a new administration coming in, which we knew was going to be very friendly to the economy and to businesses in the country and to the stock market, et cetera. But we didn't really know everything that they were going to do, what their priorities were, and whether or not the various things that have been talked about on the campaign trail would actually take effect in the economy in different ways in the form of policy. And so we adopted that chutes and ladders metaphor, which essentially reflected the uncertainty yet the optimism of a game board that was tilted upwards. And that's sort of what we got last year. This year, by comparison, we're coming into the year, we have probably a bit more of a mixed picture in terms of the signals that we're getting on the economy. And we'll talk about that in a moment. But by the same token, we are able to put our finger on what we think are the major vectors that will really shape this year. And we can be specific about it more so than we were last year. And so we came up with the term economic experimentation to talk about specifically trade, labor, and debt and those areas of the economy, because what's happening in those areas is quite unprecedented in many important respects. And that word experimentation is really designed for us to connote two things. One is that these different forces that are occurring in each of these domains are, in fact, somewhat unprecedented. As an example, think about the labor market. We're moving into a period where the total labor force, the supply of workers in the country, is shrinking for the first time in the history of the country on a secular or structural basis. So in each of these three areas, we have a particular trend that we've identified that represents a long-term structural or likely secular trend that doesn't have a lot, if any, precedence. And that's the idea of experimentation. But the other aspect of experimentation, which we think is so important, is that as we try to decipher how these various forces on the economy will actually play out, we need to take a very scientific approach. There's a lot of emotion involved on some of these issues. And with the experimental approach, we all know the scientific method involves observation. We put things in place, we run the experiment, and we observe what happens. So there's a lot of empiricism, if you will, in figuring out how it is that these major trends, whether it be the labor force that I've alluded to, the continuing situation with tariffs, or whether it be the unprecedented level of debt to GDP, which we can see for the first time is really affecting the bond market. And so we want to be able to look very specifically at how these trends are actually impacting the economy and markets through observation to determine how they will continue to play out over time. And if finally, Lisa, there's a third common denominator among these three major trends, it's that we believe that AI, which has sort of been a big wave crisscrossing the ocean, but not really hitting the shore, we think that AI is hitting the shore now in a big way. And we think that the strength and the impact of AI is very likely to have a determinative impact on how each of these three major trends, in fact, plays out over the coming year.
So thank you for that, Tony. And so with that framing in mind, and before we bring Megan and Luke in to discuss the CM themes in depth, could you hit some high points of the year ahead outlook for both the economy as well as the markets?
Yeah, absolutely. So I mentioned that we have some mixed signals, Lisa, but we have optimism. So let me start with the optimism real quickly. Here are the positives that we see coming into the year, which would probably lead you to think that we're very bullish, but we're not that bullish actually. So we see continued real wage growth. People's income is growing after inflation, notwithstanding the higher prices, because people are getting paid more money. That's great. We just had the retail sales this morning, and retail sales for the month of November rather than December, but retail sales were strong, up 0.4%, month over month. And so we're seeing good consumer resilience. We've all heard about the K-shaped economy, but overall, we're seeing good spending on the part of consumers, and consumers make up 2/3 of the economy. We also see strong outlook for companies. For the S&P 500, 13 to 14% year over year for consensus forecast for earnings growth. That's a big number. That's a good number. We're seeing mortgage rates come down for the first time in quite a while. So we're seeing mortgage rates today sit at levels that we haven't seen for about 4 years. And we're seeing refinances really picking up. That's a great tailwind for the economy. We're also seeing positive GDP momentum coming into the year. So the third quarter came out on a delayed basis, but it was, I think, 4.3, 4.4%. And so far for the fourth quarter, the Atlanta Fed is indicating a pretty good quarter for the fourth quarter, too, certainly above the 2% trend that we've seen looking in the rearview mirror for many years. We also have, we think, a very dovish view on inflation. So we had CPI come out yesterday. We had PPI come out this morning, and they're both running around 2% on a core basis month over month, which is not a level that we're particularly concerned on a go-forward basis. And we're also seeing oil prices really at very low levels on both a nominal and even more so a real basis. We also have the administration, of course, that in the context of an election year is very focused on taking actions to try to strengthen the economy so that the economy is doing terrific when we get to November. So that's another tailwind. And you've seen actions such as $200 billion of purchasing mortgage-backed securities in order to push those mortgage rates down, and other recent actions in the last few days. And then last and most importantly, that impact of AI and productivity we're incredibly excited about how it's going to actually increase efficiency in businesses and add to GDP. Having said all of that, though, there is one area that we're very concerned about. And moving to that next slide, this is the labor market. And what you see here is that if you take out healthcare from the amount of new jobs that are being created in the economy month over month, we're actually losing jobs in the private sector of the economy, ex healthcare. You can see that on the far right in that little yellow circle. And if you go back 30 or 35 years, what you'll see is that we've never had a period where the total number of job creation in the country, net of healthcare, has gone negative, but not had a recession. And so being very cognizant of how important the labor market is in the overall picture and seeing that drop all the way over on the right-hand side of this chart, we're only neutral on equities. We're not overweight, we're not underweight. We have a full allocation to equities, but we are very concerned around that development of the labor force on a go-forward basis. So if you put all this together into the high-level points, just going to that final slide on the overall outlook, before Luke gets into more detail on our themes from an economic standpoint, you'll see that we're expecting the economy to grow this year over the course of the year, given that slowing in the labor force, only around 1% or so. We're expecting to see the unemployment rate increase to around 4.8% by the second half of the year. We are expecting to see inflation continue to come down, particularly in that services area. In the goods area, it's harder to predict, Lisa, just because we don't know how the Supreme Court is going to rule on the tariffs and what the administration's response may be if it's not a favorable ruling to the administration. So that's a big unknown. And we do think that the Fed, while they're not going to cut in January, we don't think, they are going to continue to cut in the first half of the year, probably get 3 more cuts. So having said all of that, we are expecting to see a decent stock market this year. Unless we actually go into recession, which is not our base case scenario, we're expecting only about a 40% chance of recession this year. We expect the stock market to continue to perform well. We expect to see volatility, though, because it's pretty richly priced. And so when we do have moments of concern around economic data or other policy actions, or even geopolitical events, which of course have been very dominant in the news cycle recently, the market will be vulnerable to pullbacks. So don't be surprised to see a 5 or 10% pullback this year in the market, and that's okay. We expect to see finally probably a expansion of multiples by just a little bit, but an expansion of earnings, growing the equity market by probably up to 8 to 10% by the end of the year. So that's the overall outlook.
All right. So is it safe to say, Tony, that we saw more ladders in 25 than shoots?
And we did, and we're from a market standpoint, we're hoping to see more ladders this year as well. But from an economic standpoint, it'll be a combination, and it's all going to. Luke and Megan are going to talk a lot about AI and how AI is going to be very determinative again on what happens this year on an economic level.
Thank you for that. All right, Luke, we're going to start off with you. The first theme of the CMF, the reshoring experiment. And it really talks about tariffs as one of the biggest experiments. And despite the widespread concern that we saw with tariffs being rolled out almost a year ago, we're still seeing very strong GDP in the US and inflation is decelerating. Why is that? And what impact are you seeing tariffs have on the overall economy, inflation, as well as affordability?
Yeah, absolutely, Lisa. And we're still squarely focused on tariffs, even though they haven't had as negative of an impact as we thought or as a lot of other people thought. I would still say that the negative impacts are there. A lot of the job impacts that Tony was just talking about, we do attribute to tariffs in addition to AI. And when we think about tariffs, we think about it through at least two lenses. First, let's look on this chart, and we can see that on the left-hand side, the effective tariff rate, the overall effective tariff rate jumped from about 2.5% when the president started his term to 12.4% in the most recent month of data. So that's about half of what you would have gotten if you remember early last year and after the Rose Garden announcements, reciprocal tariffs, all of that. People doing calculations, including us, saying, the effective tariff rate is going to be 25%, double what we're actually seeing so far. And what we've had is multiple impacts, such as exports from China, which would have the highest tariffs, being rerouted through other countries. You also have a ton of exclusions that came over time, and also trade deals or trade agreements. They haven't been inked as deals yet, reducing a lot of those tariffs. So the overall tariff load has not been as large as stated, and has been brought down either because of those deals and by sidestepping, if you will, by some of the exporters. The importance here, when we think about the economic outlook that you're asking about and that Tony just talked about, is that the tariffs have had the impact that we would have expected on the prices of goods. Right-hand side, that yellow shaded region showing that the prices of goods really did accelerate in 2025 as the impact of those tariffs hit producers and importers, and then those were passed on partially to consumers, and that drove up the prices of goods. But as we expected pretty much all of last year, we never expected it to drive overall inflation higher. We can see that the core CPI, that dark line in the middle, has continued to mostly trend down. It's actually very close to the Fed's target. And that's because consumers were not willing and able to take on all of those tariff price increases and also shop on other things. And we've seen the services, the gray line on top there, continue to drift down. And that was our expectation all year. That's why we expected more Fed rate cuts. And we indeed got 3 Fed rate cuts at the end of last year. And we would expect it to keep happening. We don't really see an inflation problem. You can see here where they did cut those 3 times. And then we expect that they'll actually be cutting more before we even get to the middle of this year, leading to one of those helpful impacts that Tony talked about. Now, we don't have a slide on it here, but I will mention that the reshoring experiment, that theme 1 in the effort by the administration, is to bring back manufacturing activity and also jobs to the U.S. And we do think that that will happen to some degree with manufacturing activity. Some types of manufacturing will be moved back here. But as we go into detail in the CMF, and we use an example of both shoes and another example with semiconductors to dimension sort of a high labor need, which is still the fact with apparel and garments and shoes and whatnot, versus something like semiconductors, which can be highly automated. We don't think that the tariffs and the administration's efforts are going to be enough to bring back the types of jobs that do require that labor, because the U.S. has such high labor costs. But there is ample opportunity. We would expect some movement of those highly automated processes like semiconductors and that higher tech manufacturing, and that probably leads to some opportunities, as we talk about in the CMF, for the types of manufacturing and the types of suppliers to manufacturing that can enable that type of activity. So on the economic side, this theme is all about that reshoring experiment. Where we land is that some of it could be brought back, but it's really going to be in the highly mechanized and the highly automated parts of manufacturing, Lisa.
Thank you for that, Luke. Love the in-depth analysis there on the tariff piece of it. So, Megan, Luke mentioned that we don't expect a wave of reshoring, but it will have some impact. So tell us about the types of companies we would expect to see this from, as well as the investment opportunities.
Yeah, definitely. And I would start with a market's perspective on why companies were moving out of the US and turning to globalization in the first place, which is quite obviously, as you might expect, it's been very profitable. And here we're showing the profit margins for manufacturers. And even those ex the technology sector, so not really related to technology, they've seen their margin growth far outpace the rest of the market. So it's been a very profitable endeavor. And now, to reiterate what Luke just said, in order to bring supply chains back, the numbers need to work. And how do you make the numbers work? Well, we do expect those industries that are more capital intensive and also higher cost to be more likely to relocate. And that's because of the advent of smart manufacturing, which we define as utilizing technology to make manufacturing more efficient. And the recent developments of technology, including AI and agentic AI, which basically takes the large language models that we have become very accustomed to a step further. And it allows AI to not only help with decisioning, but actually to execute those decisions without any additional human involvement. This becomes very critical when you think about the possibility of humanless manufacturing plants. So what we've seen is that the companies that have been adopting smart manufacturing are those that are, as I said, more expensive goods and more capital intensive. Automotive, electronics, pharmaceuticals, aerospace, and those are some of the companies that we would expect over time to be more likely to relocate back to the US, or even just to distribute their supply chains a little bit away from those very low cost countries. And this will take time. It is actually more likely, in our view, in the near term, that you might see companies already located here in the US expand their existing operations, because setting up a brand new high tech manufacturing plant is obviously very expensive. So it would really be a matter of over time seeing this develop. And as we look at the investments on the right-hand side of this page, industrial capital goods are a quite obvious one in our view that is a beneficiary of this trend. Now, industrials are a little bit more expensive than the market, but still, in our view, reasonably priced. We're also looking at AI software, which we'll talk a little bit more about. Cybersecurity, something that we have been talking about for quite a while. It is a more expensive part of the market. But when you actually think about the amount of technology intensity that will be going into everything, including manufacturing plants, the need for cybersecurity grows. So it's really hard to understate the growth projections of the cybersecurity sector. And then lastly, a lot of these areas are ripe for small businesses to participate, but getting the funding, as I said, it's quite expensive, can be challenging. So the private markets, private equity and private debt markets, can be very interesting ways to play this smart manufacturing and reshoring theme over a long investment horizon.
Thank you for that, Megan. And as you said, we'll go more in depth on those investment opportunities a little bit later. But we're going to move on to the second theme, Luke. Back to you again. The second theme is the labor experiment, and it really focuses on the fact that the labor force is at risk of outright shrinking. So, how unusual is that, and why is it important?
It would be unprecedented to have a decline in the labor force in the structural manner that Tony described in the intro. And what we're showing here are the congressional budget offices in tandem with the census. Their projections for that structural change, like the light teal area, is just net natural increase. So the amount of births minus the amount of deaths. And sort of the important takeaway here, and what we point out in the full report, is that our population, if no immigration, if we have zero immigration, would actually start to turn negative in 2030 or 2031 based on current births minus deaths projections. So we do rely, and we have relied on immigration for a lot of our population growth for quite some time. And in turn, that drives the labor force growth. So this is part and parcel of how an economy works. And the growth of an economy basically comes down to how much is your labor force growing, and then how productive is that labor force? How much is each person making as they go to work? So the importance of this slide is really that the net immigration, that blue area, is it's a lever. It's like a choice variable that goes into this economic experimentation. The current administration is pulling back on the amount of immigration that comes into the country, not just illegal immigration, but also legal immigration in terms of the number of refugees, the number of H-1B visas, that type of thing. The CBO has plugged in what amounts to here almost 1 million people a year, that flat dark blue area. But if it comes down below that, then we will be facing even slower population growth and even slower labor force growth. And so what that does is it's going to weigh, like we have that slower labor force growth, it's going to weigh significantly on the overall growth of the economy unless we have higher productivity. So we would need to have much higher productivity in order to counteract this force. And we do think that that is possible. We've had it happen in the past. But that's what we're looking at from a demographic point of view, Lisa, with the labor force and the experimentation in the second theme.
Thank you for that. And this visual certainly points it out very, very clearly. So I appreciate the dialogue there on that. So Tony, with the shrinking labor force in mind, the second theme also brings together the risks of job destruction from AI, as well as where we are in the AI business cycle. So we heard that productivity growth is key to offsetting a shrinking labor force. So the question is, can AI help?
Yeah, it's such an important and great question, Lisa. And I could cite lots of statistics around how much capital is being invested in AI by the hyperscalers, which are the companies that are providing the cloud services for the consumers of AI. But instead of doing that, I'm going to give you a quick anecdote, and then we'll talk about the chart real quickly. So, as you've learned as my boss, Lisa, I have a very quirky, but hopefully charming personality sometimes, just a little bit. So one of my quirks is that I like to collect fancy pocket knives. And so about 6 weeks ago, I got one of these knives, and I was playing with it in the kitchen, and I cut my finger pretty badly. And of course, my wife immediately rolled her eyes, said, "Why do you even do this?" And I ran upstairs and got a Band-Aid, and I thought I would probably need to get stitches, but I didn't, and it healed. So 6 or 7 weeks later, Monday of this week, it was driving me crazy. So I went to the doctor, and I saw a registered nurse. So I walked in to see the registered nurse, and she said, "Do you mind if we record this?" I said, "Sure." So I told her what was going on, and what my symptoms were, what had happened. And she looked at her screen and said, I think that you might have septic arthritis in your joint, and you may need to get an x-ray. But if you don't have that, I think you're going to be fine. And she's prescribed an x-ray, and we ended the conversation. And essentially what happened was, while I was speaking in real time, there was a bot, if you will, in the background that was evaluating what I had said, and it recommended that she consider this course of treatment option, and it prevented the need from a doctor to have to come into the room. And so it did two things essentially. At the end of the day, it created efficiency in the system and potentially created a better outcome, because she might not have thought of that particular course of treatment, and the doctor, if he or she had even come in to the room, might not have thought of that. And so it's a great illustration. And I asked her, by the way, I said, when did this become available? And she said, only within the last 2 or 3 months we started doing this. And I said, do you see more patients as a result of this? And she said, absolutely. They're increasing our patient load. And so it's an example of just one point around how it is that AI, which is, again, that sort of wave that we've all heard about, but it's actually really starting to hit the shore now. And just in the last few months, you're seeing companies really adopt different techniques, different technologies that are starting to impact our daily lives or intersecting with this all the time. Now, the chart that we have here on AI shows where productivity is right now. Luke is going to talk in a few moments around how a 2 to 3% productivity level can have such a profound impact on our economy and the trajectory of our sovereign debt. But if you look on the right-hand side of this page, you'll see the level of productivity right now. The two lines below that shaded orange area shows where the CBO, the Congressional Budget Office, is forecasting productivity to be, which is around 1% is their baseline. And if we have a really good outcome, they're thinking it may be around 1.4%. So the CBO is projecting productivity to come down. If we get a boost from AI, as we hope or expect, we think that productivity at a minimum will meet that CBO high mark, come down to there. But there's a good chance that productivity will stay in that orange area, above 2%. And if we have productivity above 2%, Lisa, it will have a very profound impact on all three of these major experiments, if you will, that are happening in the economy. Now, you may read a lot about the fact that companies are saying that, well, I have AI happening in my company, but I'm not yet really seeing the efficiencies or not seeing the profits, et cetera. And to that, I would point to the left-hand side of this chart. So on the left-hand side of the chart, you see at the very left-hand side, the first internet browser came on the landscape in the early 1990s. And it was only about 6 or 7 years later that we got a massive productivity boom that lasted about 7 or 8 years as a result of the advent of the internet. And you can see that in that shaded yellow area there, that lasted for quite a period of time. And so what we're seeing today, actually, productivity numbers have been very high today. And we don't believe that that's primarily due to AI. We think it's due to the fact that coming out of the pandemic, companies, and due to the uncertainty associated with our tariff policies and trade policies, companies have been very, very reluctant to hire, and they've been trying to run their businesses much more efficiently. And that is resulting in greater productivity. And that's very common to see when the economy slows, to see companies increase productivity. So we believe that is what's been driving productivity of late. But we think that the impact from AI is starting to hit now and will really hit on a go-forward basis. And we think there's a real chance that productivity will stay in that higher range. And Luke will talk in a few moments around how much a small difference in the productivity level can actually impact the long-term trajectory of the economy.
Thank you for that, Tony. And quirky and endearing, you said it.
By the way, my finger is okay. I know that you were worried, so I just wanted to make sure I clarify that.
I'm glad that the finger's okay. But before we get to Luke, we're gonna go back to Megan on a couple items, and as promised, getting a bit deeper into the investment opportunity, and specifically, it's around AI, Megan. So, are there any areas that still look appealing, or are valuations too much of a risk?
I think what we tend to hear a lot in my conversations with clients and even with other investors is a tendency to paint the AI investment opportunity with a broad brush and talk about it as either appealing or not. But it is a very complex landscape, and there are many layers to the investment opportunity, which we're showing here. So starting at the very top, which I would argue semiconductors, hyperscalers, and then that next gray row, data centers, energy, and utilities, they're all part of the infrastructure of AI. And this is where most of the focus has been. So I think semiconductors, hyperscalers, these are probably more interesting opportunities from our perspective. Hyperscalers, as Tony mentioned, are a lot of those big companies that are very focused on providing the cloud capabilities. So Meta, Microsoft, Amazon, web services, their valuations of all of the kind of infrastructure opportunities, valuations are probably the least stretched for the hyperscalers. And they also have some nice diversification of revenue streams. If you look at data centers, energy, and utilities, this has been really interesting because these are, in some cases, more, especially utilities, more defensive sectors, but they've been participating with the strong market momentum because, as we know, there's a tremendous amount of energy usage, also a really robust build out of data centers that is happening here. But valuations are a little bit stretched in this part of the market. And we're also a little cautious, especially on data centers, because what we're seeing is a lot of the bigger companies are building out their own data center capacity. So those REITs or other real estate investment opportunities don't get to participate quite as much. As we move down this speaker, intelligence are those companies, many in the private space, that are generating the AI models that we have come to rely upon. Here, valuations are very stretched and not an area that we're, really participating in. But again, there is some exposure there on the hyperscaler side. Where it starts to get more interesting is at the bottom, and we do have the beaker gets wider, which I think is appropriate because the investment opportunity, especially on that last layer, the adopters of AI, is very huge. It is basically all of the companies across sectors who would be using this AI to drive the productivity gains that we've talked about before as being so important. And here it's really about rolling up your sleeves and figuring out which companies are doing this well and which are not. Which companies within a sector might be very strong and early adopters, effective adopters of AI, and which are not. What we're finding so far is that there's not a lot of evidence of productivity gains, but you do tend to see that needing to take some time for business processes to be adapted and adopted and changed. And small companies in particular, they tend to be more agile and more able to adopt, change, and then, if it's not working, move on to another possible solution. So that is something that we are, rolling up our sleeves on across the portfolio to figure out where we might see those highest productivity benefits.
And as I reflect on what you said, Megan, it does feel a lot like those .com days, which kind of gets to this next question, which is, you're talking about these very positive applications, and yet, the market still seems very skittish about the return on the massive investments being made. So what are your thoughts on this?
There is a lot of investment happening, and this has been, in some ways, a bit of an unloved bull market so far because there is a lot of skepticism, and I get it. It's a little bit hard to suspend disbelief and put ourselves in the future to figure out just how real these technology applications could be. They sound like they might be great, but obviously putting them into practice and seeing real productivity gains, that's a whole other thing. And the investment needs to be reasonable enough that you can earn a return on that and see it pay off over time. And what we've seen is that since the launch of ChatGPT, a hyperscaler CapEx has doubled, and it's expected to increase by another 50% just by the end of this year. In addition, the market has become very attuned to how this spending is occurring. In other words, during 2020 to call it 2024, much of the CapEx spending was coming from cash on balance sheets, these fortress balance sheets of the big mega cap tech companies. 2025 was a bit of a pivotal year in that we saw these companies turning more towards the debt markets. And if you look at the debt issuance from the hyperscalers as a percent of the CapEx, it went from 10% in 2024 to 35% in 2025. So a big jump there obviously gets people a little bit more nervous that the spend may result in a tech bubble or a debt bubble or something of that nature. Not anything that we are really worried about right now. We actually still think there's a lot of opportunity in this space, but it is something to be watching, especially on the debt issuance side.
Thank you for that, the further clarification. We're going to move over to the third theme, Tony, which is titled The Debt Experiment. And we have to be honest with each other. Debt, yeah, it's been an issue for a long time. So why the focus now?
Yeah, it's a really great question. We talk about it every year, Lisa, for many, many years as a concern, but we're really highlighting it this year. And the reason is that this is the first time that we are seeing a persistent impact of the level of debt in the country on the bond market. So we're seeing, and I'll show you what I mean by that in a moment. But if we start here and we show the amount of deficit that we're accruing on this chart, the U.S. is orange, and these other developed market countries, France, Germany, Japan, the UK, et cetera, are the other lines. And on this chart, being lower is bad, which is to say that the way the chart is set up, we're running a higher deficit the lower that we are. And so you can see that the U.S. structurally has been running very high deficits for quite a while here. We continue to run deficits that are around 7 or 8% of GDP, just adding, Lisa, to that debt year after year. But if we go forward to the next slide, what you'll see is that what we call the term premium of the yield curve, which is to say the additional amount that the government has to pay a borrower if they borrow for 30 years versus 10 years, is getting larger and larger of late. And that means that the buyers of debt, the participants in the bond market are starting to worry that over a long period of time, the currency or the overall picture of the U.S. economy will become more inflationary as a result of the printing of money and the amount of debt that the government is taking on, and or the overall economy will slow down into sort of a stagnation, if you will. And so you can see during the pandemic, during that 2020 to 21 period, we had these 10 to 30-year credit spreads around the levels that they are today, that they've very recently reached, where the 30-year keeps going up. And that was because of all of the fiscal spending and all the uncertainty around the pandemic that prevented us from going into more of a depressionary scenario. So that was necessary. But going forward, if we see us break through the levels that we're currently at of around 60 to 70 basis points and get closer to 100 basis points, those are going to become very concerning levels as it relates to the willingness of participants in the bond market to buy longer-term U.S. debt, and that's specifically as a result of the amount of indebtedness that we have. And going forward one slide, you can also see the same type of phenomenon in the shorter end of the yield curve. And this slide is showing us the spread between the 2-year and the 10-year. And so there's a very faint line in the middle. And when we're below that, we have the so-called inverted yield curve. And when we're above that, we have a positively sloped yield curve. And the higher the line is, the steeper the yield curve is. And so right now, what you're seeing is that even though the Fed has been cutting rates, the steepness of the yield curve has been increasing. Ordinarily, what happens when the economy slows is that investors start to position in advance of a potential recession. They sell stocks, they buy bonds, and that buying of bonds pushes down rates of bonds. And so when you have a slowing economy, you typically have a flattening yield curve. And indeed, you often get an inverted yield curve right before a recession. And while, again, a recession is not our base case scenario right now, you're seeing a slowing economy in our view, and the prospects for an even slower economy going into the year. And notwithstanding that, you're seeing the shape of the yield curve in terms of the 2 to 10-year bond actually steepening out. And so it's that 10-year bond getting stuck over 4% instead of coming down into that mid-3 area, which is where we would expect it, that tells us that there's something that is in the nature of an experiment happening that's untested, and we're just not sure how it's going to play out if we continue to run this level of indebtedness in the economy.
Well, another great visual of what you're articulating. So thank you for that. As we're talking about rates, so one of the most important roles of rates is its transmission into the housing market. What are you seeing there?
Yeah, that's a great question because it's really hard to think about the economy running at the long-term trend rate of 2% without participation of the housing market. And the housing market has been sort of stagnant now for quite a while, which is to say that there's a lot of folks out there, as this visual demonstrates, that have very low mortgages, and they can't as effectively afford to downsize or to move to a different home because they would be moving to a home. The mortgages are not transportable, of course, in this country, and therefore they'd be moving to a new property and they'd have a higher mortgage rate. And so, in order to be able to get the animal spirits back in the housing market, you need to see mortgage rates come down below long-term mortgage rates below 5%, which means you need to see the 10-year, given the spread of mortgages traditionally over the 10-year, to come down probably into the mid threes. And we've been sort of stuck in that 4.15 to 4% range on the 10-year, and we haven't been able to get it down any lower than that. So that would be in and of itself pretty problematic for the housing market, but for the fact that, to the administration's credit, they did come up with an announcement earlier this week, or was it last week, excuse me, which has had a direct impact on the housing market, and it has resulted in those lower mortgage rates I referred to earlier, Lisa, in the conversation, which is that they said, let's start by buying at $200 billion of mortgage rates, of mortgages, and that is essentially pushing down the spread of mortgage rates above treasuries. So even though the 10-year is not moving, the spread of mortgages over the 10-year is starting to shrink, and that's pushing mortgage rates down. So there's a limit in how much those spreads are likely to shrink as a result of purchasing these mortgages on the part of Fannie Mae and Freddie Mac. But that could significantly help the situation in and of itself. So I'm a little bit more optimistic, frankly, about the housing market for this year than I was when we put the slide together a couple of weeks ago as a result of this recent action on the part of the administration.
Glad to hear your optimism, and I'm sure many out there are as well. So Luke, we're gonna bring back the idea of productivity, which is very important to the debt and interest rate risks that Tony discussed. And so, what type of productivity impact do you expect as a result of AI, and what does this mean for the debt trajectory?
Yeah, Lisa, and this is key. If everybody can just think back to the productivity chart that Tony showed, it showed the historical growth, and then there were these two lines that were sort of to the bottom right, and that's where these come back. This is again going back to the Congressional Budget Office, which does the official projections of what's going to happen to the debt of the country, and this is as a percent of GDP. And these are the scary projections that you get, and when you read about when you have legislation that's passing that's cutting taxes and what's going to happen to the debt. And that baseline dotted line is the baseline expectation from the Congressional Budget Office, and it shows our debt as a percent of GDP rising from about 100% to 160% over the next 30 years. And that's the kind of scary thing that the country would not be able to handle. You know, it drives up those longer term interest rates. But if you think back to that productivity chart, the CBO is using 0.9% growth in productivity for their baseline forecast. And then, as Tony had pointed out on that previous chart, oh, well, they also have a high productivity scenario. If productivity was just half a percentage point higher at 1.4%, then look what happens to the debt. It's that line on the bottom. It actually plateaus before it gets to 120% of GDP and then comes down. And if you also think back to that chart and where we think we're going to get a boost from artificial intelligence, it was around 2 to 2.5%. So that would actually, if nothing else changes, which is a huge assumption, would probably drive our debt down, and we'd be able to be paying down debt and reducing the debt load as a percentage of GDP. And that, of course, has precedent. The reason in that productivity chart that we point out the very strong growth at the end of the 1990s, and Tony pointed out it came with a lag after sort of the expansion of the internet, is that that was the last time that the United States government was paying down its debt. It was because you got this boost in productivity, fast-growing economy, higher growth receipts, and you're able to pay it down. So we expect from artificial intelligence to get that stronger productivity. I mean, it's really going to, Megan said it really well, as you get to the fat bottom part of that beaker, if the users of AI that end up using it the most and sort of the biggest impact, and that's all kinds of businesses availing themselves of the technology, much as businesses avail themselves of internet technology and making the entire economy more productive. So the key message about productivity as we get into theme 3 here about debt is that it really, really could have a huge impact because that stronger productivity growth will help on the debt side, Lisa.
Thank you. Well, we'll wait and see what happens there. So Megan, briefly take us through the key investment opportunities in 26 and our current positioning.
A few things that we have our eye on, and one of them is market concentration. So Tony mentioned at the outset we could see higher volatility this year. One of the reasons for that is because the market has become increasingly concentrated, more driven by just a handful of the largest companies. And what we're pointing out here is that the top 10 stocks by size in the S&P 500 are about 40% of the index, but markets are concentrated pretty much around the globe. So this really makes diversification important. It is an opportunity, especially if those top 10 names fall out of favor, for active management to do better because they do tend to hold a lot of other names other than those largest companies. And we are talking about diversifying not just US and international, but also across cap size. Small cap is an area that has not been the best performer in a portfolio. We've actually, over time, become more interested in private markets as a way, in private equity as a way to play the smallest companies in the cap space. But this is definitely, market concentration is something to be watching. On the next slide, we do have a pretty constructive outlook for the equity market in the year ahead. I think Tony mentioned at the outset, high single-digit returns expected on the back of pretty robust earnings growth, probably not all that much multiple expansion. But one thing we do expect is a broadening and a continued broadening of equity market participation, in part driven by that earnings outlook. So here we're showing the dark blue bars are historical and projected earnings growth for the Magnificent Seven. And then the teal bars are historical and projected earnings growth for the rest of the market. So what you'll notice is that historically, we've had really strong earnings growth from those mega cap tech companies. And that's expected to continue to be an outsized share of the earnings growth. But these bars are converging as we go out into 2026 and 2027. So what that means is that we're going to see slower earnings growth, probably, from the big tech companies and continued improvement in the rest of the market. So that speaks to a broadening of participation and what I would describe as a healthier equity market. Moving to the next slide, and then I'll just jump right to positioning. I do think it's important to think about valuations and what's driven the market and just have a proper view of that, because as I said earlier, it seems like the market's just been climbing this wall of worry and it's a bit of an unloved bull market. Since the April lows last year, when those massive tariffs were announced, the market, the S&P 500, is now up more than 37%. Valuations are full, but I would say not overly expensive, such that we are, driving an underweight to equities. And last year, 2025 return for the S&P 500 for the calendar year was about 18%. Most of that did come from really strong earnings growth of almost 15%. Multiples did expand a little bit, but a lot of that did come from really strong earnings growth, which is why the earnings projections Tony talked about at the outset of the call are so important. So if we skip the next slide and just go right to where we are in positioning, we have a full allocation to equities. Within that, continuing to have a preference for higher quality stocks, which significantly underperformed, last year. We expect our expectation for slower economic growth, as well as just sort of mean reversion under outperformance of those higher quality names to do better. And that's why we want to stay positioned there. Within fixed income, similarly, we have a preference for quality, overweighting investment grade, underweighting high yield. Again, seeing a little bit of softness there.
Great. Thank you for that, Megan. So first of all, Tony, Megan, and Luke, thank you as always for sharing your invaluable insights. And thank you to everyone for joining us today. We know your time is valuable, so when you spend it with us, we very much appreciate it. The full 2026 capital markets forecast is available at wilmingtontrust.com. Your advisor is ready to help you interpret these insights and adjust your strategy as needed, always to stay focused on your long-term goals. So if you don't work currently with a Wilmington Trust advisor, we would love to connect. So just reach out and we'll set up a conversation. We appreciate your time today and wish you a great rest of your day.